Hello, my favorite federal employee. You want to invest your TSP like a professional, and I'm here to pull back the curtain and share with you how we do this day in and day out for all of our clients, how we assist them with their TSP allocations, and how we coordinate it with all of their other investments and their overall financial plan. And that's what I'm going to unpack with you today on today's video. I'm Andrew McNair, son of a CSRS employee, founder of SWAN Capital, a total wealth management firm where we have a CPA and estate planning attorney all under one roof. Plus, we are the founders of the Signet Real Estate Fund, which both companies serve federal employees like you every day. So each week, I meet with TSP millionaires, families who have practiced delayed gratification, lived frugally, and saved diligently in their TSP for decades. And I always enjoy learning about their strategies for reaching their first $1 million in TSP. And so we're eager to uncover these strategies and share them with you, to share their methods that they've used and whether they had any special techniques along the way. And the truth isn't as glamorous as you might think. The key to amassing over 1 million or 2 million in your TSP is consistent effort, making the right decisions day in and day out. There's really no special workout, there's no special diet, and there's definitely no strategy that is so unique that you've never heard of. But I'm going to pull it all together and make sure that you're doing the right reps. Nearly all TSP millionaires I've met share these common traits. Number one, they invest first and they spend what's last. Sadly, the poor do the complete opposite, right? They oftentimes spend first and then invest last. So wealthy individuals prioritize savings before spending. They start with contributions around 5%, probably early in their career, or 10%, because the match was, of course, 5%. And then gradually they increased to the maximum as quickly as they could. When catch-up provisions became available at age 50, they took advantage of that additional $7,500 contribution limit at the time of this recording. Today, you can contribute up to $30,500 if you're over the age of 50 and $23,000 if you're under the age of 50, again, at the time of this recording. Every pay raise and promotion was used to boost TSP contributions. So every time they got a pay raise, they got a promotion, they got a next step increase, do you know what they did? They did not let their expectations increase faster than their earnings. Many of my millionaire clients paid off all of their debts except their mortgage usually, with some even paying off their homes entirely before they got to retirement. And so what we do is ensure that they maximize both their Roth IRA and spouse's IRA. Even if the other spouse did not have any income, we wanted to make sure that we maximize the Roth IRA as well as their Roth IRA. So for those with VA disability or military pensions, we directed those funds to go into tax-free accounts for the future. Why get a tax-free check like a VA disability only to put it into an investment bucket that they're going to have to pay taxes in the future? Number two, very selective with investment choices. Most TSP millionaires invested with the end in mind, tuning out all the noise of financial news and office gossip, all the barracks lawyer along the way of the Joe at the water cooler that was giving them advice. No, they didn't listen. They remain invested in C, S, and I with a strong preference for C. They were often more aggressive because they knew their money wasn't working hard for them like they were working hard day in and day out within the G fund. And a poignant example is a single woman in her early 60s who was 2 years from retirement when she came to me. She had her TSP entirely in the G fund. And upon review of her statement, we're preparing her federal benefits report for her, we realized that if she had just followed the investment mix that we recommend, she could have had close to $1.2 million instead of the $400,000 that was only in her TSP. And it's really a lesson in persistence with the wrong strategy. And it's so important to get that right investment mix done correctly on the front end and let compound interest work for you over the long haul. Next is avoiding stock overlap. As we approach retirement, it's crucial to ensure that outside investments like your spouse's 401k, your outside IRA, don't overlap excessively with your TSP allocations. Many federal employees that we have as clients come to us with IRAs and brokerage accounts that have significant stock overlap within their TSP investments. So this stock overlap can lead to redundant investments, as well as unnecessary fees to buy and sell the same stock. So I want to show you an example of this on the screen here. You can see a client's real stock intersection report that shows this overlap. You can see that this client right here has more exposure to Microsoft and Apple as well as NVIDIA than maybe they even realized. They had exposure within their C fund, but also they had money at Victory, Conservative, Moderation, Aggressive, so Victory Capital with their USAA accounts. And this client has so much stock overlap that they didn't even realize. Sometimes they had maybe 5% of one company that they did not even know they had so much exposure to Apple. And here's what's really important about this stock overlap report is it shows that when you have Apple being bought by the C fund and heavily invested within the C fund, you might have this other mutual fund that's selling Apple, and then your spouse's 401k is holding Apple. And before you know it, you're buying, selling, and holding the same position. And this is why we run reports like this to make sure that our clients are not being inefficient with their investments. So proper analysis of these investments often reveals sector imbalances and inadequate diversification. I'll show you another graph right here. So right here you can see the basic sectors of our economy. And so this oversimplified view of our sectors is really helpful though, because if you're invested in the C fund, you're invested in a mutual fund, you might not realize that you have 27% of your holdings are in technology. And you think, well, I don't have that much exposure to technology, but once they're overlaid upon one another, you say, wow, I did not know I had 27% in technology. And here's why that's a problem. Because if another 2008 happens and you have a quarter of your money in financial stocks, you wish you wouldn't have, because financial stocks were heavily beat up during, of course, 2008. Well, let's go back to 2000, during the dot-com crash, right? During the dot-com crash, if you had over a quarter of your money in technology, you wish you wouldn't have. And as we get closer into retirement or to retirement, you're going to want assets and sectors that pay dividends. So technology, for example, is not known for being a big dividend producer. They're known for growth. So integrating things like real estate, things like utilities and energy are sectors that we do want to have a presence in because they provide dividends. So very important to make sure that you don't miss this right there. The next mistake that I want to talk about is making sure that you don't load up on the G fund and the C fund too early. When we're planning for retirement, when we start getting 1 to 3 years out from retirement, we have to start changing our investment strategy. Sadly, so many families start doing this too early. I've heard this countless times. Well, the older I get, the less risk I should be taking, right, Andrew? And I say, no, not necessarily, because I have federal employees that retire at 52 and 72. So it can't be based on merely age, but when you start drawing income from your investments. So as you near retirement, it's important to build up your G fund to cover the first 5 years of your retirement income for your go-go years, those years where you're going out and traveling and pursuing your hobbies and spending excess money during those first 5 years of retirement. And we discuss building an income bridge in other videos that you can watch. So the key is to have a plan and stick to it. If you think about it like this, if you were managing an endowment like Yale's endowment, you would have a strategy. And it would be written out, I would hope. If you were investing for the sovereign wealth fund of the Cherokee Indians, or if you were investing for CalPERS, the pension fund for California's employees, I would hope you would have an investment policy statement. Do you know what most families are doing with their TSP? They're subscribed to someone that's selling a newsletter online. That person has no recourse. That person doesn't have a room in their house for you to live in. So make sure that you work with a financial advisor that has plenty of E&O insurance. I have to have $2 million E&O insurance in case we give bad advice and someone sues us. Because it's very important to make sure that when you take advice from someone, that they have skin in the game. right? Because if someone's just selling you a newsletter and they give you bad advice, it's not, again, them that loses, you lose. Now, they may say they have some of their money in TSP invested the exact way, but unless you're checking their books and checking their statement and they're posting it publicly online, they may be just selling you a newsletter. Now, since 2012, the savviest TSP millionaires have been keenly aware of taxation. There are 4 types of taxation that you should understand, and you should see your statements from Uncle Sam's perspective. I call it looking down from Big Brother, looking at the drone footage of your money. And this is really important. If we're looking at your money as this graph shows, your money can come in multiple different colors, multiple different flavors. There's 4 major types of taxation. You have qualified assets. That's money in a TSP, an IRA, or 401k that's never been taxed. And the problem with that is if tax rates go higher, that's frozen income. You've not yet paid taxes on that. Second, you have to worry about RMDs. With qualified accounts, you'll have to take an RMD when you stop working. Number 3, is you have to worry about your marital status. Remember that we sadly punish some widows because their tax brackets get cut in half when their loved one passes away, when their spouse passes away. So qualified assets are risky because we don't know what the future of taxes are going to be on them. You can also see their taxable accounts. I encourage you, do not accumulate a lot of money in CDs and brokerage accounts and checking accounts and money markets. Why? Because they're taxable, meaning what little interest you get paid for at the bank, that money is taxed once again on the interest earned. Then we want to integrate things like non-qualified assets and capital gains treated assets. So these are things like real estate where I buy a property for $100,000, a piece of land, and then I sell it for $150,000. Well, the $100,000 I've already paid taxes on, but the $50,000 I've not yet paid taxes. So it's important to have assets like that because they're taxed at a different rate called capital gains, and I only pay the taxes when I want to, not when the government wants me to. But the best type of money is tax-free, and tax diversification is so key. A lot of people, they go over-index on just Roth accounts, just tax-free accounts. There are 5 tax-free vehicles. There's Roth IRAs, Roth TSPs, life insurance, municipal bond, and HSAs. And this is why we have a CPA in office to help families navigate Roth conversions, to navigate max funding their Roth IRAs even while they're still working, even while they're still maximizing their Roth TSP. A lot of people don't realize that you can do both. You can contribute to a Roth TSP and a Roth IRA. So very important to get this right. Now, the other graph that I want to show you is the equity style box. Now, this is taken directly from a new client's report that I ran for them that has to do with their capitalization diversification. So that's a lot of words. So let me unpack that. So a lot of families, they'll just invest in the C fund because they've heard that that had some of the best returns. The issue is what is showing up right here in black and white, or I should say blue and black. So you can see that this client has a lot of their money in large company stocks. These are the large GEs and Apples that you're well aware of. And actually you can see they're heavily tilted into growth companies that are large. That's like investing in Alabama football while they're still winning, but one day that dynasty will come to an end, like it did. And then you want to have exposure to medium and small companies. And here's why. Because those companies tend to be more nimble. During economic recessions, they can pivot in winter times like large companies cannot. Also, we know historically that small companies and medium companies can also outperform large companies, and they all have their day in the sun, and that's why you want to have exposure to all of them. So don't neglect the S fund. Don't neglect your outside investments investing in small and medium-sized companies. Many of these companies have hundreds of millions of dollars of revenue, and you don't want to miss out on them. So when investing like the pros do, you have to understand there are things outside of your control. I can't control geopolitical events. I can't control elections or what the Fed does, but I can control 3 main aspects of my client's TSP. Alongside them, I can help them contribute the right amount. I can also affect their investment choices with the advice that we give, and we can also focus on tax diversifications. Here's what I'll tell you. Professionals never tire of the basics. Kobe Bryant, at the peak of his career, still practiced the fundamentals daily. Can you believe that? Kobe Bryant, God rest his soul, always focused on the fundamentals. Professional investors are no different. Professional investors embrace delayed gratification. They embrace patience and sticking to their plans without deviations. They don't try to outsmart the basics. I hope this was super helpful. If you have federal retirement questions that are still lingering that we haven't answered here on this video, shoot us an email at the email address below in the description, and we'll try to create a video about it or at least answer your question. Also, if you want to get a one-on-one visit with one of my advisors or me to go over your TSP allocations and make sure that you're investing like a professional, all you have to do is click the link below. Maybe you're looking for something more comprehensive where we can look at your tax strategy, your estate plan. We can look at your federal benefits. We produce a comprehensive federal retirement report that looks at your FEHB options, FEGLI options with your life insurance. We look at survivor benefit decisions. All of that is a great deep dive into your benefits, which is really important if you're about to retire. So take us up on this complimentary report by clicking the link below. Now, my firm is based in the Gulf Coast of Pensacola. Now, in Pensacola, Florida, we serve families all over the world, wherever families are stationed. And so all you have to do to schedule one of those comprehensive federal retirement reports is call that number, 1-800-848-8768. That's 1-800-848-8768. Again, I hope you have a blessed day, and we'll see you next time on the channel.